Good morning and welcome. I'm Reena Agarwal, the Robert Emmett Professor of Finance here at the McDonough School of Business at Georgetown University, and I'm also the director of the Psaros Center for Financial Markets and Policy. It really is a privilege today to host the newly confirmed Federal Reserve Vice Chair for Supervision, Chair Bowman. She's been a longtime friend and supporter of the Psaros Center. Congratulations, Vice Chair Bowman, on your new role. We're delighted to welcome you back to Georgetown University and to the Psaros Center, and we're really eager to hear your insights on your supervisory and regulatory policy agenda. At the Georgetown Psaros Center, we are committed to providing objective, research-driven expertise to support both policymakers and market participants. We offer a unique value as an intellectually honest broker, facilitator, and educator for practitioners, policymakers, and the broader community. Our work is essential in ensuring clarity and objectivity in the evolving issues around finance and policy. Our impact extends beyond the financial sector. It resonates through the global community because a well-functioning banking and financial sector is crucial for job creation, for innovation, and for addressing complex global issues. The Georgetown Psaros Center is a leading authority in unbiased expertise at the intersection of global finance and policy. I also want to welcome another good friend, Treasury Deputy Secretary Mike Falklander, who is with us today. With that, Vice Chair Bowman, I will hand it over to you. The floor is yours. Thank you.
Well, good morning, and I'd like to start by thanking Reena for having me here this morning, and David Vandeveer, a longtime friend who is running the Psaros Center here at Georgetown. It's the second time I've been with this center and hosted for a speech here, and I really appreciate the opportunity to come back and to speak about my agenda as the incoming Vice Chair for Supervision at the Federal Reserve. It's truly a pleasure to join you today for my first public remarks, having recently been confirmed by the Senate as the Federal Reserve Board's Vice Chair for Supervision. Today, I will describe my approach to leading the Fed's Division of Supervision and Regulation in its vital work to promote the safe and sound operation of the U.S. banking system. I have spoken extensively in the past about my principles for supervision and regulation, which will continue to guide my approach to supervision in the bank regulatory framework going forward. At the core of these principles is pragmatism, which focuses on first identifying the problem to be solved and then developing efficient solutions. Once we have identified a need for reform or a problem to be solved, our next task is to conduct a careful analysis of the intended and the unintended consequences of any proposed policy solution, and to consider alternative approaches that lead to lower cost or to better outcomes. The views that I'm going to share with you today reflect my initial thoughts about how these principles should be incorporated into the important work required to improve supervision and regulation in the future. Addressing first, enhancing supervision to more effectively and efficiently meet the Fed's safety and soundness goals. Second, reviewing and reforming the capital framework to ensure that it is appropriately designed and calibrated. Third, reviewing regulations and information collections to ensure that this framework remains viable. And finally, considering approaches to ensure the applications process is transparent, predictable, and fair. I'll start with enhancing supervision. Supervision focused on material financial risks that threaten a bank's safety and soundness is inherently more effective and efficient. We should be cautious about the temptation to overemphasize or become distracted by relatively less important procedural and documentation shortcomings. Fundamentally, as I've noted in the past, our goal should be to prioritize the identification of material financial risks and encourage prompt action to mitigate risks that threaten safety and soundness. There are a number of changes that we can implement in the near future to better enable us to accomplish this goal. And the first of those is tailoring. Risks are not uniform, and each bank is unique based on its business model, its complexity, and its business profile. I am a longtime proponent of tailoring banking regulations. And going forward, we will extend the application of tailoring to our supervisory approach to financial institutions, not only among bank categories, but also within a particular category. In the past, the board has pushed down requirements meant to apply to the largest firms to smaller banks, often including regional and community banks. One approach that would preserve tailoring is to create an independent community bank supervisory and regulatory framework to clearly separate these banks from larger supervision and regulation. This would serve to insulate these smaller banks from standards that are designed for larger and more complex firms. While I have no objection to a deliberate, intentional policy to apply similar standards to firms with similar characteristics as the conditions may warrant, the gradual erosion of distinct regulatory and supervisory standards among firms with very different characteristics, essentially the subtle reversal of tailoring over time, is not a reasonable approach for implementing supervision and regulation. Both regulators and legislators should consider whether the bank regulatory framework includes appropriate thresholds for defining distinct categories of institutions, and whether simple fixes, like indexing thresholds to inflation or growth, could better ensure a sound, tailored approach that remains durable over time. It's clear that the current $10 billion threshold defining upper bounds of a community bank leaves many institutions that pursue this business model of community and relationship banking subject to heightened requirements more suitable for larger and more complex firms. To further these objectives, later this year I will host a conference on small and community bank issues to discuss improving the bank regulatory framework to adopt an efficient, tailored approach for these firms. We must demonstrate wisdom and courage by carefully listening to those who are subject to regulatory oversight and considering ways to enhance our approaches to both supervision and regulation. One issue that continues to present challenges for smaller banks is check fraud. The ongoing increase in bank losses to this type of fraud can negatively impact the perceived safety of the banking system and result in significant consumer harm. Past efforts by regulators have been frustratingly slow to advance and seem to have done little to address the underlying root causes of this increase in fraud. I will continue to work to identify specific actions that can be taken to reduce the incidence of fraud, including through expediting the remediation process for check fraud after it occurs. I expect that the Federal Reserve, in coordination with the OCC and the FDIC, will soon take action on this important issue. Turning to bank ratings, in my mind, ratings must reflect risk, and yet we've seen gradual changes in supervisory approaches that have eroded the link between ratings and actual financial condition. Federal Reserve supervisory statistics show that 2/3 of the largest financial institutions in the U.S. were rated unsatisfactory in the first half of 2024. At the same time, the majority of these same institutions met all of the supervisory expectations for capital and liquidity. This odd mismatch between financial condition and supervisory ratings requires careful review and appropriate revisions to our current approach. Under the current large bank ratings framework, a single component rating can result in a firm being considered not well managed, which has driven the disparity between well-managed status and financial condition. The Federal Reserve will soon begin to address this mismatch by proposing changes to the large financial institution ratings framework. The proposed changes will be designed to result in a more sensible approach to determining whether a firm is well managed, no longer disproportionately weighting a single framework component for a firm that has demonstrated resilience under a range of conditions and stresses. This initial change could help address the gap between assessed ratings and material financial risk for those firms who are subject to this framework. We have an obligation to ensure that our supervisory ratings are current, that they're credible, and that they actually reflect material financial risk. This promotes effective supervision, and it ensures that firms are accurately rated based on their underlying financial strength, which should increase the public's confidence in our assessment of the banking system. We must also consider the appropriateness of the broader ratings framework, which applies to smaller institutions, including the CAMELS framework. Are these frameworks appropriately tailored to capture material financial risks, particularly for elements that rely on subjective examiner judgment? While judgment is a legitimate and necessary tool in supervision, it must always be grounded in the materiality of the identified issues as they relate to the financial health of each institution and the banking system as a whole. This has been a notable shift in supervision, not only for large banks, but also for regional and for community banks. So the next issue under supervision is improving prioritization. Our examiners review a broad range of activities in the supervisory process. A random sample of examination reports demonstrates that supervisory focus has shifted away from core financial risks like credit, interest rate, and liquidity risk to process-related concerns. While process is important for effective management, there is a risk that overemphasis on process and supervisory box checking can be a distraction from the core purpose of supervision, which is to examine financial condition and financial risk. Checklists should not distract examiners from the central purpose of our examinations process. Another tool that we will be reviewing is, with a critical lens, is the use of horizontal reviews. In theory, horizontal reviews, where examiners conduct a narrow but deep review on a particular topic across multiple banks, can help improve an examiner's perspective. When they're used effectively, horizontal reviews can help supervisors better understand the range of industry practices. But these reviews have quickly evolved into oversimplification of complex issues and often include grading on a curve, where firms are rank ordered with an expectation that implementing a simpler approach fails to meet expectations, under the assumption that the more complex approach is more appropriate for all firms. Unfortunately, this side-by-side comparison fails to address the only question that matters: whether a firm's approach meets the appropriate legal and supervisory standards for the individual firm's characteristics. Differences in approaches are not indicative of shortcomings, particularly since these can often be explained by distinguishing the underlying activities, the scope and scale of the bank's operations, and the firm's board of directors and management's tolerance for risk. There's also a lack of transparency in the results of these exams, and a risk that horizontal reviews will create generally applicable rules without complying with the Administrative Procedure Act. So I'll be looking closely at whether the continued use of horizontal exams going forward is appropriate, and if so, to ensure that these exams are sufficiently transparent and they reflect proper respect for the APA and do not circumvent our responsibility to provide each regulated institution with a fair, firm-specific evaluation. So I'll turn now to talk about the role of guidance in our supervision. This is the last topic that I'll discuss in supervision, which is the important role of guidance in the supervisory process. Our guidance can be an effective tool to promote transparency in supervisory expectations, to provide clarity to regulated institutions on the permissibility of new activities and their associated risks, and to provide firms' perspective on compliance with statutory and regulatory requirements. Structured with these goals in mind, guidance can effectively further the objective of supervisory prioritization. But where guidance does not further these objectives, it is worth revisiting. And I think it's important that we review our wide range of existing guidance, including outstanding supervision and regulation letters, which we call SR letters. Any guidance that addresses issues that may adversely affect innovation, like the extensive guidance related to third-party risk management, and the many other guidance documents that have been issued in recent years. Fundamentally, guidance should clarify expectations and provide answers to industry questions, just as the office hours guidance from several years ago that provided a venue for banks and innovators to share information on new products and services like digital asset activities and artificial intelligence. But changing expectations around the use of guidance as a tool to promote clarity in supervisory expectations can encourage innovation in the banking system. But uncertainty in supervisory expectations has long been an obstacle to banks seeking to innovate, including banks engaging in digital asset activities or incorporating new technologies like artificial intelligence to improve efficiency and the delivery of products and services. Just as it's imperative that banks innovate to remain competitive in the future, it is critical that bank supervisors enable the adoption of new technologies in a manner consistent with safety and soundness. So on our examiner training and workforce development, I'd like to focus on the training that our examiners are required to undergo to participate in the exam process. Our examiners must engage in a challenging education program, and they have to pass rigorous tests before they qualify to become a commissioned examiner. Those who have obtained this license have a strong foundation that they can rely on when they're conducting their examinations. The commission demonstrates an elevated level of expertise, judgment, and fairness that these examiners bring to their work. As such, they should not shy away from transparency or from public accountability. But currently, the Federal Reserve does not require all of our staff that are involved in supervision and bank regulation to have met or be on a path to meet this credential. Regulated entities should be able to expect that all of our examination and supervisory teams have achieved or are working to achieve this level of professional expertise. And going forward, the Fed will prioritize this training, particularly as we face an aging workforce across the federal banking agencies that will require our new examination staff to ensure the safety of the soundness of the banking system into the future. Failure to invest in and plan for examiner training today will result in much less effective supervision in the years to come. So I'll turn now to talk about capital in the banking system. Our capital requirements are an important component of the prudential regulatory framework, and they are essential for the stability of interconnected banking and financial systems around the world. Yet too often, our efforts to address capital reform take a piecemeal approach to capital requirements. We tend to review individual elements of the capital framework in isolation, without considering whether proposed changes are sensible in the aggregate and contribute to a capital framework in which all of the components work together effectively. While each component is important, the aggregate calibration of requirements is ultimately the most meaningful, and we must examine whether this approach in totality appropriately captures risk. Overly calibrated capital requirements effectively create market distortions, disfavoring some activities over others in a way that's divorced from prudential safety and soundness and a bank's ability to support economic conditions. Leverage ratios are one example that illustrates this concern. The Federal Reserve has long acknowledged that leverage ratios are intended to act as a backstop to risk-based capital requirements. When leverage ratios become the binding capital constraint at an excessive level, they can create market distortions. This is especially true in the case of the enhanced supplementary leverage ratio, or the ESLR, which is applicable to the largest banks. As a result of this leverage requirement, banks are less inclined to engage in low-risk activities, like treasury market intermediation, and they revise their business activities in a way that is neither justified nor responsive to their customer needs. But these distortions can also create broader financial system impacts, like increased stress on treasury market functioning. And to be clear, the increasing bindingness of the ESLR on the largest firms did not result from careful policy debate and discussion. Instead, it's an unintended consequence of market and other bank regulatory requirements that were implemented after it was originally put in place. The original calibration of the ESLR was based on forecasts of the level of reserves and other so-called safe assets in the system that are now far out of line with current levels. I expect that in the near future, the agencies will publish a proposal to help address this concern and ensure that the ESLR resumes functioning as a backstop capital requirement. While this fix to the ESLR is necessary, it may not be sufficient to address issues in the capital framework. And in July, the Federal Reserve will host a conference that will broaden our perspective in the consideration of capital requirements for the large banks. We will bring together bankers, academics, and other capital experts to examine whether capital requirements, as currently structured and calibrated, are operating as they were intended, in a complementary fashion. I welcome the opportunity to consider a broader range of perspectives as we look to the future of capital framework reforms. In addition to considering potential changes to leverage ratio requirements and stress testing, the Capital Conference will also include a discussion of potential reforms to the GSIB surcharge and the Basel III capital requirements. The board has already proposed a significant change to reduce the volatility in capital requirements resulting from our current stress testing process. This proposal includes providing a longer implementation timeline to phase in the annual stress capital buffer requirement. And later this year, the board will consider more extensive changes aimed at promoting transparency, fairness, and predictability in the stress testing program. While stress testing is an important supervisory tool, its implementation, outcomes, and processes have raised significant questions and concerns about its effectiveness in identifying systemic weakness. The lack of transparency around the models used in stress testing prevents meaningful discussions about how the stress test can be improved. Capital has a significant impact on the business activities of all banks. Although the capital framework for the smallest institutions tends to be simpler and more straightforward, calibration and design elements play an important role in the functioning of smaller banks, just as they do for larger banks. So it's important that we also take the opportunity to address issues for smaller banks that provide critical support to their local communities and to their local economy. On this front, we will review and consider the community bank framework, including capital requirements like the calibration of the community bank leverage ratio, and whether reforms to the capital framework for mutual banks can be improved to promote capital formation. So I look forward to the results of the public engagement on these issues, including through our upcoming conferences. And I hope that you all will tune in or participate. As we're considering bank capital requirements, the focus should be on achieving a capital framework that provides a strong foundation for the banking system, that it appropriately requires banks to hold capital corresponding to risk, and works together with bank supervision to support a safe and sound banking system. So a part of the initiatives that are on my agenda is to review regulations and information collections. Since the passage of the Dodd-Frank Act nearly 15 years ago, the body of regulations that all banks are subject to has increased dramatically. Many of the reforms made after the 2008 financial crisis were important and essential to ensuring a stronger and more resilient banking system. Yet a number of the changes that were made were backward-looking, responding only to that mortgage crisis and not fully considering the potential future unintended consequences of future states of the world. Now, with well over a decade of change in the banking system now behind us post-implementation, it's time to evaluate whether all of these changes continue to be relevant. Some of the regulations put in place immediately after that financial crisis resulted in pushing foundational activities out of the regulated banking system into the less regulated corners of the financial system. So we need to ask ourselves whether this continues to be appropriate, and was it appropriate at the time? We know that these trade-offs are complicated, and we must consider not only the changes that were made, but also the evolution of and differences in the banking system that we have today. In any case, driving all risk out of the banking system is at odds with the fundamental nature of the business of banking. Banks must be able to earn a profit and grow while also managing their risks. Adding requirements that impose more costs must be balanced with whether the new requirements make the correct trade-offs between safety and soundness and enabling banks to serve their customers and run their businesses. The task of policymakers and regulators is not to eliminate risk from the banking system, but it is rather to ensure that the risk is appropriately and effectively managed. In a well-functioning regulated banking system, banks serve an indispensable role in credit provision and in economic stability. The goal is to create and maintain a system that supports safe and sound banking practices and results in the implementation of proper risk management. Our goal should not be to prevent banks from failing or even eliminate the risk that they will fail. Our goal should be to make banks safe to fail, meaning that they can be allowed to fail without threatening to destabilize the rest of the banking system. So I'll turn now to the maintenance of the regulatory framework. Regularly reviewing this framework is necessary to ensure that our regulations continue to strike the right balance between encouraging growth and innovation and safety and soundness. One easily identifiable way to achieve this is using the Economic Growth and Regulatory Paperwork Reduction Act, better known as the AGRIPA review process, which the agencies initiated in February of last year. This process requires the federal banking agencies to identify any outdated, unnecessary, or overly burdensome regulations, to eliminate unnecessary regulations, and take other steps to address the regulatory burdens associated with these outdated or overly burdensome regulations. Our prior iterations of the AGRIPA process have been underwhelming in their ability to result in meaningful change. But it's my expectation that in this review, and eventually the accompanying report to Congress, will provide a meaningful process for stakeholders and the public to engage with the banking agencies in identifying regulations that are no longer necessary or are overly burdensome. It's also my expectations that regulators will be responsive to concerns that are raised by the public through this process. Another area ripe for review are several of the board's rules that address core banking issues, from loans to insiders, to transactions with affiliates, to state member bank activities, and domestic and foreign activities of bank holding companies. Many of these board regulations have not been comprehensively reviewed or updated in more than 20 years. Given the dynamic nature of the banking system and how the economy and banking and financial services industries have evolved over that time, we should update and simplify many of the board's regulations including the thresholds for applicability and benchmarks. So I want to turn now to talk about one of the final things in my agenda today, which is about banking applications. The process to file an application and to receive regulatory approval, whether it involves banks seeking a de novo charter, institutions seeking to merge, or any other bank application that requires regulatory approval, should reflect both transparency about the information required in the application and the standards of approval, and clear timelines for regulatory action. Our recent experience with banking applications suggests that revisions would be helpful in this space. And streamlining the applications for de novo formation and establishing clearer standards for approval may actually encourage more de novo activity. Similar problems have affected bank mergers and acquisitions, where there have been lengthy processing delays. We need to think about whether many of the additional requests for information that are part of the process can be addressed through better applications forms or relying on information that may be available from existing bank examinations. But we should also consider factors that force applications to be removed from our Reserve Bank delegated process to requiring consideration by the board. One example is the perverse effect of competitive screens that disproportionately affect transactions in rural and underserved banking markets. Another is the treatment of adverse public comments that may lack factual support or rely on matters that are already considered in the review process, including our existing supervisory records. So in closing, I'm honored to be here at the Psaros Center and to have the opportunity to speak, having just been confirmed by the Senate as the Vice Chair for Supervision. The work of supervision and regulation is critical to maintaining a safe and sound banking system and protecting U.S. financial stability. Conditions are constantly evolving in the banking system, and so too must the regulatory and supervisory framework. We must be proactive and responsive in the face of emerging risks and ensure that the framework operates in an efficient and effective manner. The steps that I've identified today are intended to further these goals by creating an initial roadmap to refocus supervisory and regulatory efforts on the core financial risks most critical to maintaining a healthy and resilient banking system. So I look forward to working with my board colleagues and my counterparts at the other agencies as we pursue sensible and pragmatic reforms. Thank you.
Thank you, Vice Chair Bowman. And please know we at the Georgetown Psaros Center are available and ready and willing to help you in your mission. Oh, it's not on. Okay. Hopefully this one works. Okay. If I might start off with a couple of questions before we open it up to our students for questions. So you talked about ratings, right? Bank ratings, and you talked about the mismatch between the ratings and the financial soundness, and you want to take a look at that some more. Are there certain types of institutions where this is more of an issue that you want to look at? And you talked about modifications to the system. What will be the consequences of these modifications on the banks, but also their customers, if any?
Oh, well, that's a great question, and I'm glad that you asked it. One of the things that we have been focusing on is ensuring that our ratings are reflective of actual bank conditions. And when we say that we have a safe and sound and healthy banking system, it doesn't reflect the conditions that we're reporting in our annual or biannual safety and soundness or supervision and regulation report that the board publishes twice a year. What we've seen in that is that 2/3 of our large institutions are rated as not well managed. But the issue is that we're not relying on actual core financial and market risks like capital and liquidity in that assessment and those ratings. So I think when we're looking at more procedural or administrative issues as a part of as driving the overall rating of those institutions, it's not reflecting the safety and soundness of the banking system, and it's something that we can easily adjust to ensure that that rating is reflecting the actual condition of the bank itself and also the banking system here in the United States.
Thank you. Another thing that we hear a lot from market participants that you've touched on is supervision and regulation that's more holistic, rather than you have many different things going on and they're kind of not holistic. So this conference that's going to be coming up next month, I think you mentioned, so are you going to look at everything there, from leverage ratios to Basel Endgame to all kinds of different issues? Is that the idea of this conference?
Well, the idea is that because we know that we'll be revisiting soon our the supplemental leverage ratio requirements, that all of these capital requirements interact with each other and have overlapping requirements that we need to ensure we're maintaining an appropriate level of capital within the system. So if we change one, we need to ensure that the others can reflect the appropriateness of what the aggregate level of capital in the system should be. So the idea is that we're already looking at our stress tests. We're looking at the ESLR. We know that Basel III needs to be finalized. And we have GSIB surcharge that is out for proposal from the previous years. So each one of these components, one, is very complex, but two, they also have so overlapping requirements that interact with each other. So it's important, as we're considering all of the pieces of the large bank capital framework, that we understand how they interact together, and that we're talking about each one of them and identifying those ways, and that when we're approaching changing one or two of those or three of them, that we understand whether or not we need to make changes to all of them.
Is there international cooperation or discussion that's required on some of these issues?
So all of these issues are things that the United States can address and review on their own. So as we're looking at Basel III, this is the international standard that has been adopted around the world. So we're the last jurisdiction to focus on and finalize a proposal for that. But as I said, all of these different pieces of the framework have a bearing on how each is calibrated. So we want to ensure that as we're finalizing large pieces that have many components like Basel III, that it works together with the other pieces of the capital framework to ensure that we're achieving an appropriate level of capital.
Thank you. With that, let me open it up to questions from our students or anyone else. Yes, please.
Thank you for your speech.
Please introduce yourself.
Of course. So I'm Pasha. I'm a student here at Georgetown University and a participant at the Psaros Center. So I have two questions. So first, can you elaborate on what aspects of the Dodd-Frank bill would you consider be like myopic and only good for responding to the mortgage crisis of 2008 and not for future conditions? Mm-hmm. And then secondly, you mentioned about examiners, and many examiners have not reached the level of credentials that you would expect of them. Can you just elaborate on why this is?
Sure. So let me start with the examiner question. As a state bank commissioner, all of your examiners are required to have a commission before they can engage in activities that are interacting with banks with confidential supervisory information. So as I joined the Fed back in November of 2018, it was my assumption that our examination teams had the same credentials as well. What I've learned since and in the last few months leading up to the Senate vote for my new role, most of our large bank examiners are not required to fulfill these education requirements. And as a part of the process of becoming a commission examiner, it takes 4 years to accomplish this. You take classes on a large range of conditions and things that you need to make sure that banks are meeting as you're doing your examination process. But you also learn important and critical communication skills, because it's not only important to deliver messages about what banks are not doing well, but you also have to be able to deliver messages about what banks are doing well, so that you have a balance in your communication and that you are being appropriately moderate in your tone. So it's important in my mind that, one, we're communicating appropriately with banks, that two, as we're looking at the largest banks, that our examiners are qualified and have developed an expertise that allows them to have credible findings in their exam reports. So this will be a part of our process, and going forward, as I said, the majority of our large bank examiners don't have this qualification. Some have committed to doing it, but many have either committed and not begun the process. So that will be a large part of what we're expecting going forward. And then to turn to the Dodd-Frank requirements, I think as a whole, Dodd-Frank has resulted in a much stronger, safer, and more resilient banking system. We've addressed a number of the issues that existed in the banking system prior to the mortgage crisis, and I think it's important that we look backward and understand how each of those components was developed, and as we're thinking and looking at the banking system now, we can identify which ones may need to be modified or may no longer apply. But I think one of the results from the Dodd-Frank requirements and the calibrations of risk weightings is about mortgage servicing and the real estate mortgages for residential real estate. And I think, I'm not sure that I would see that residential mortgages not being conducted by banks within the regulatory perimeter has resulted in a better outcome. So I think there are lots of things that we can look at and determine whether or not they were appropriately calibrated. Thanks for the questions.
Yes, please.
Hi, so my name is Andrew Devine. I'm a master's student here. My question was about bank process and the M&A process in particular, and you had mentioned that's going to be a focus in the Fed for now, and how do you see that evolving?
So I think first we need to understand what our metrics look like and how, whether we're meeting them or not. I think what we've seen in a number of different reviews is that we often far exceed the statutory deadlines and timelines for making a determination or a decision. So part of the problem with that is that as banks are in limbo, waiting for a determination on an application, they're suffering reputational harm, and their employees don't have any idea what their future might hold if it's an acquisition. In addition, sometimes banks have scheduled conversions for their software processes and the complex systems that they have within their banks to run their business. And when they have to delay those kinds of deadlines or timelines, it's often very expensive. So what you're expecting or budgeting when you start an applications process can oftentimes be nowhere close and a year or more down the line. So these are things that we need to be mindful of. We need to understand the consequences of delaying decisions, and we need to make sure that we're creating a system that's transparent, fair, and predictable.
Any other questions? Okay. Yes, please. Yeah, again, I just want to emphasize, please, if there are questions from our students from the Georgetown community. Actually, if I might ask you one.
Of course.
You touched a little bit about on AI and digital assets and innovation. There's a lot of innovation that happens in the financial sector and with banks. What is the role of regulation? What is the role of policymakers in not working? Sorry about that. So what is the role in terms of the innovation that's happening with banks in the financial sector? Technology has always been used a huge amount by the sector. What is the role of regulators? What is the role of policymakers?
So I think one thing that I've focused on since having been a banker and then as a state bank commissioner and now having been at the Fed for over 6 years, it's important that we continue to enable banks to access innovation and that we not curtail their ability to engage simply because we don't understand the technology that they would like to engage in. I've spoken about this a number of times, and I think that it's imperative for regulators not to just reflexively say no. I think we need to fully understand whatever the technology or process or service is that a bank would like to engage in before we say, writ large, no, you can't engage in those kinds of activities. It's our job to ensure that if a bank is going to engage in innovation or artificial intelligence or other types of technology, that we create guardrails that allow us, one, to fully understand what that additional technology might be, how it might affect their ability to continue to do business in a safe and sound way, and that they can engage in those activities so that it doesn't imperil their bank.
This is terrific. As you know, we have a great program at Georgetown. We call them our Psaros Center Fin Policy Scholars, and they get to visit a number of institutions in Washington, policymakers, and you have hosted them also. And they really get to learn from a policy angle what is important, and then they get to visit market participants and the private sector. So we're trying to educate the next group of leaders who will go into public service. So, but I'm getting the signal that I need to stop, so I want to be mindful of your time. Thank you so much for being here today.
Thank you very much for hosting me. I appreciate it.